So here we have problem 5-31, and this is a problem that looks at some more mixed streams of cash flows. So let's open up the table and see what we have. We have two different sets of cash flow streams. We've got A and B. We got 5 years of data for each. Looks like there's different figures for each year, so not a problem. You can see how they both total $150,000. So really the point of this problem is to see which is more valuable. Obviously, they both total to 150,000, but based on how much is received early on in cash flow A that can earn interest, how is that going to compare to cash flow B or stream B that receives more or bigger chunks of payments towards the end of the 5 year period? So just looking at the numbers here, we can kind of assume that cash flow A, or I'm sorry, cash stream A will be more valuable when we calculate the present values, just because there are more years for these larger amounts to earn interest on. So at any rate, we've also got given to us a 14% discount rate. So as we're working through problems, we keep seeing different terms that are all synonymous for the interest rate that we're using. So we've seen opportunity cost, we've seen discount rate, there's required rate of return, there's cost of capital. When we get to chapter 9, we'll talk more specifically about how this interest rate is determined for a firm. But pretty much every time other than chapter 9, this number is going to be given to you. So unless, of course, we're doing a time value of money problem where it's asking you based on other given figures what the assumed interest rate is. So let's open up our financial calculator and let's work with the cash flow register again to calculate the present values of these mixed streams. So we're going to look at stream A first. And so what we have is a opportunity cost or discount rate again of 14%. So let's enter that up here. 14 is our interest rate. And hit the cash flow button. That's going to carry the rate up top. We have no cash flow at time 0. That's a chapter 10 thing that we'll get to. Cash flow 1 is 45,000. Enter that. That's just one time. So we'll leave frequency 1 as 1. Cash flow 2 is 37,500. Enter that. That's just one time. So frequency 2 will be 1. Cash flow 3 is 30,000. Enter. Cash flow 4 is 22,500. Enter. Again, I'm just arrowing quickly down past the frequency since they're all just 1, and 1 is the default input on these. And cash flow 5 is 15,000. That. Just one time, of course. So now we can compute NPV. And again, careful that we're computing NPV and not PV. So it's really the same thing, being that there's no upfront cash flow. We're really computing the present value since there's nothing to net. There's no upfront cost to net it out with. But being that we're using the cash flow register, we use net present value. Later we'll use internal rate of return a little bit as well. But this present value button here is for the 5 key, the traditional 5 key approach. So when we're in the cash flow register, we use the NPV button, not the PV button. So we did compute NPV, and that's our net present value or present value for stream A, which is 109,690 and 20 cents. Let's check that. Okay, and now let's look at the present value of stream B. And I'm just going to reset it just for simplicity, and we'll do the 14 rate again. Cash flow button to carry the rate up in the top. No upfront cash flow outgoing, so cash flow 1 is 15,000 in this case. Just basically doing them in the reverse. One time, cash flow 2 is 22,500. Cash flow 3 is 30,000. Enter. Arrow down, frequency is 1, cash flow 4 is 37,500. See, now I made a mistake there, so there's a couple different ways I can fix that. So I can use the delete button here to back out, or I could have just hit the clear line screen, but easier just to hit the delete button. So $37,500. Enter. Arrow down. And the final cash flow is $45,000. Enter. Arrow down. It's still frequency 1 as well. So let's do compute present value, net present value. And we've got an answer of $96,294.66. Okay. So as expected, as we were just kind of taking a look at the figures up front before we started the problem, being that the higher dollar amounts are received or factored in earlier in the 5-year period, there's more time for these larger dollar amounts to accumulate interest. So just based off of kind of our assumption up front, it's validated when we calculate the final present values, in that cash flow stream A has a higher net present value because there's more money received at the beginning of the period that has more time to accrue interest. And so to answer the second question, which says compare the calculated present values and discuss them in light of the undiscounted cash flows totaling $150,000. The undiscounted cash flows just means the total of the cash flows is the same. They're both $150,000, but which is more valuable based on when they're received. And in this case, we have, let's see, cash flow stream A is $109,690, so we know it's narrowed down to these three here. Cash flow stream A with a present value of $109,690 is higher, so we can narrow it down to this one or this one. Higher than cash flow stream B's present value of $96,295 because the larger cash inflows occur in A in the later years. No, they don't occur in the later years, they occur in the earlier years, so it must be this one. It's higher than cash flow stream B's present value of $96,295 because the larger cash inflows occur in A in the earlier years when their present value is greater, while the smaller cash flows are received further in the future.